Hey, welcome back to The Dive. Today on the show, we have the chief strategist and founder of Mill Street Research, Sam Burns. Sam's joining us today to share his thoughts on Amazon's potential acquisition of AMC theaters, crypto risks, AI impacting jobs, the recent bank failures, and the Fed's next move. He's also going to explain some charts that Mill Street Research has found interesting. And be sure to stick around till the end to hear Sam's advice for investors in this economic climate. Hey, Sam, welcome back to The Dive. Thank you so much for joining us today.
It's my pleasure. Thank you for having me.
Okay, so Sam, AMC was up 10% shortly, following a report that Amazon is exploring an acquisition of the movie theater chain. Do you think that it makes any sense for Amazon to purchase movie theaters?
I mean, if they have aspirations of making their own movies and then potentially having a distribution, platform for it. I don't really know how the economics will work in terms of, whether that would be beneficial for Amazon. I guess it would certainly help AMC shareholders in some ways. But I think that, that if you see Apple and Amazon and Netflix and other content distributors getting more into content production, then the natural thing would be to go beyond streaming and try to find ways to distribute their work more in the traditional way through movie theaters, potentially. And if they can buy something cheap, then potentially that might be a useful thing for them to do. But I don't really know how all the details would work for them, or if they could pull that off.
Do you think movie theaters really have much of a future?
I think they do to some degree. There's definitely still people who like to go to the theater and experience things that way. It might be a somewhat smaller industry overall, when all is said and done in the long run, just because there are much more options in terms of people watching at home. That streaming is probably a permanent fixture of the market now, in one way or another. But I think there is still things people liked about going to the theater, and so there will be a market for that to some degree in the long run, I think.
Okay, so let's move on and talk about crypto for a second. Binance has been in the headlines lately, and the chairman of the CFTC says Binance continues to dodge U.S. regulations. He says U.S. citizens are using the platform through VPNs as part of an ongoing fraud. How much risk is there in the crypto world right now?
Well, certainly from what I can see, there's quite a bit of risk. There's a lot of that kind of thing going on where the regulators are taking a closer look at what's really going on by some of the people who operate in the business. And certainly there's been plenty of, high profile, kind of blowups and things that have happened in the last few years. And I think the fact that, there's still a lot of things that people don't know about how some of these operations work, whether it's the exchanges or the currencies and things that they're trading themselves. There's a lot of risk there. You don't really know who you're dealing with a lot of times, what they're doing with your money. And so I think there's going to be a lot of risk there from a regulatory standpoint, in addition to the risk from just volatility in the crypto assets and things like that has been there for a long time. I think the business case for a lot of these things is still yet to be seen. A lot of it has to do with getting around rules and regulations of one form or another in different countries. And I think that's going to be it's going to be harder to do that as the regulators start to take a closer look at things. So I would say there's probably still quite a bit of risk there.
Do you think that the U.S. may work to cut off crypto from the SWIFT banking system?
It's a possibility. I think that banks that are currently, kind of traditional banks that are embedded in the current system will be more hesitant to do a lot of crypto-related business. And certainly I think it was Signature Bank that had exposure there as well, and that they seem to have, had issues with that. So I think there's going to be more of that going forward, so that if you are any kind of regulated, licensed traditional bank, that it's going to be harder to make the case that you should be more exposed to, crypto-related things rather than less. Now, for ones that are not part of the traditional banking system, maybe it's a different question. But I think that the regulatory oversight is going to get larger, not smaller.
Do you think that the recent failures of Silicon Valley and Signature Bank, followed by Credit Suisse's rescue, reignited recession risks?
I think there's a lot of people who are taking that view that it is going to reduce bank lending and therefore cause a recession to become more likely. My own view is that that's probably not as big a risk as people have made it recently. I think that those particular banks had a lot of problems already and were not well run. And so this was the sort of the event that tipped them over, but they may have had, we're going to have issues either way. I think the general banking system overall is probably fine. I think that lending will probably slow down some, but it was already very high. It was due to slow down and is probably slowing down now already, just because the general economy, economic activity is slowing. I don't think we're in a recession or going to go into a recession right now or anytime real soon. I think that's a risk for maybe for later, depending on what policymakers do. But I don't think the banks themselves are going to cause the recession. And I think the banks that did go under or had to be rescued, that was going to happen either way, and that's not a systemic issue that's going to cause recession by itself.
Do you think that the Fed is done raising rates?
If it's not, it is probably very close. I would expect at most one more quarter-point rate hike would probably be all that they would do at this point, both given where they are in rates, the trend in inflation, and the issues with the banking system. They're trying to, kind of thread the needle between showing that they still have strong inflation-fighting credentials and are not, giving up on the fight for inflation, but also that they're going to support the banking system and not let banks go under or make the conditions that cause those bank issues worse. And part of the reason those banks had problems was that rates went up so fast, and that their bond portfolios were not positioned for that, and they took losses. Now, most banks are not taking those kind of losses to that degree, but part of what has caused that was the Fed raising rates so fast. So if the Fed realizes that maybe being so aggressive on rates has been part of the problem, they might be more inclined to at least slow down, if not stop, and allow what they've done to kind of work its way through the system before they do anything else.
We'd also like to get your thoughts on AI. In an open letter published by the Future of Life Institute, Elon Musk and a group of AI experts are calling for a 6-month pause in developing systems more powerful than GPT-4, citing potential risks to society and humanity. In your view, what role will AI play in shaping the future of work?
Well, I definitely think that there will be a greater role for AI-based systems and turning things that are currently done by humans manually into things that an AI can do, that computers can do. And that's certainly been something that's been going on for many, many years, ever since computers were invented. Essentially, that's been the case. So this may be a sort of an acceleration of that, or in certain industries, going to have a bigger effect. My guess is it's going to be hard to really enforce any kind of a ban or a slowdown on development of this sort of thing. Certainly not globally. I don't know how you would enforce something like that. And I think recognizing the risks that come with technological development makes sense, but I don't see where the enforcement would come from, or whether the downsides are really going to overwhelm the upsides in some respects. People have made that argument about a lot of different technologies over the years. And, if there's job losses in one area, they tend to be, new jobs created in other areas. So I would say that overall, it's probably not the dire risk maybe that some are making it out to be, but that it's certainly worth keeping an eye on.
When you think about investing in AI, what are the areas that you find most interesting?
Yeah, and it's tough to find, what you'd call pure plays, I guess, in AI, meaning companies that will benefit kind of strictly from growth in AI in general, or their own product very specifically, just because there are so many competing products out there and things are changing so fast. That was certainly the case in the early days of the internet, when it was unclear who was going to be the sort of the winner. We knew the internet was going to be a big deal. We didn't know which particular companies were going to be best positioned to take advantage of it. And a lot of the ones that looked like they were the winners early on turned out not to be the long-term winners. I think it's important to keep things like that in mind as you try to make money off of AI. There's certainly the respective companies that make AI develop products. There's also companies that will use AI to reduce their own costs and improve their own profits, which is a much broader sort of market, and is probably where you should maybe look a little more closely to see who can use AI to reduce their costs or build better products, as opposed to just who is making the AI products themselves.
Okay, so let's move on and talk about some of your charts. Could you walk us through the S&P 500 realized volatility? What is this telling us?
Right. And I think there it's a question of what is the market doing versus what do the headlines make you think it's doing. Sometimes you read the headlines, you'd think that the market is falling apart, that things are terrible, that it's super volatile and high risk. But if you actually look at the volatility of this S&P 500 over the last, say, month or the last 3 months, it really hasn't been that volatile and has actually been recovering in the last couple of weeks. So all the banking crisis and all the worries about everything else that's going on in the world really have not caused the kind of explosive volatility that you might think was happening. And certainly when you compare it to even the volatility that's happening in the bond market, which is normally the safe area, bonds are proportionally speaking more volatile than stocks nowadays. So I think stocks are not as risky as people think, and other areas might be maybe more risky. And so I think it's probably a better bet to keep your money in stocks and not run away in terms of being worried about the banks or anything else right now, because it's really not coming through in the overall general index price that we see in the S&P 500.
Okay, now you also published the S&P Case-Shiller home price data as of January. What is this telling us?
Well, here it's really making the point that home prices in the U.S. nationally are still coming down. That data captures home resale prices month by month, and they've been actually falling for 7 consecutive months now. So the question there is, what does that tell us about inflation overall and the housing market in particular, and also what's likely to influence the Fed? And I think the issue there is that the CPI and a lot of the inflation data that people look at is influenced. About 30% or so of the CPI is housing prices, shelter, rent. And that data in the CPI, because of the way it's constructed, makes it look like housing prices are still going up and still accelerating. But they're actually, if you look at the data like the Case-Shiller data or data that Zillow publishes on rents, those data have been slowing rapidly and are actually starting to fall. So it's a question of whether you're looking at basically data that's lagged, which is what's in the CPI by construction. They're not doing anything wrong. That's how it works. Or data that's more current, like this Case-Shiller data. You can see that housing and rent prices are in fact slowing rapidly and actually maybe going negative, which means that the inflation pressure is actually less than what it looks like in the CPI. And that tells you that the inflation story is probably better than it looks like if you just look at the headlines. And so again, looking below the headlines, is important. And this is more data that says that the interest rate increases and the mortgage rate increases that have happened are already slowing down housing prices and have been for 6 or 7 months now. And that's been having an effect already and probably will for a number of months to come. And therefore, the need to raise rates further is probably much less right now.
Okay, so one more question for you here. What advice would you give investors watching on how they should approach the current economic climate?
Well, I would say, I guess, first off, don't panic. That's generally good advice, but I think right now there's a lot that's there to kind of scare you. And I think that keeping exposure to equities makes sense right now. Most of the indicators I look at are still net positive for equities. I think, fixed income, your bonds, you probably want to be in the shorter term bonds, money market funds, things like that, where you can get a higher rate and less volatility than you would in long-term bonds. I think, other asset classes are probably going to be bumpy. I don't really think commodities are going to do all that well. I don't think, things like commercial real estate are going to do very well. So I think that, stocks and some, cash and short-term bonds are probably the place to be. But I don't think that, panicking about a recession or the end of the world is going to be, real helpful right now. And there's certainly plenty of people out there that would tell you to do that. So, my advice in general would be to not panic and probably stay with the plan you've got and to keep some exposure to stocks and risk assets, even though it looks a little risky out there.
Okay, great. Well, Sam, thank you so much for coming on today. Before you leave, could you let our viewers know where they could go to hear more from you?
Sure. So certainly my Twitter account at Mill Street Research is where I post pretty frequently with kind of comments and some examples of the work that I do. The millstreetresearch.com website has other examples in my reports and a blog. And LinkedIn also has some posts that I post periodically there. So social media and the website are probably the best place to find me.
Okay, great. Well, thank you so much for coming on and sharing some of your expertise with us, Sam. It's been a pleasure.
My pleasure. Thanks very much.
To our audience at home, thank you so much for tuning in today. We will be back again tomorrow, so be sure to stay tuned by hitting that notification bell and subscribing below before you leave us. Bye.